Hey YouTube, it's Dimitri, and today we're going to talk about career value. So, one of the subscribers basically asked the question, like, do you have value in your job? Like, do you feel that you are adding value? Or, more commonly, right, a lot of people think, like, do you think that you are somewhat greedy because the finance industry is greedy and banks are greedy and all they care about is making money? So, let's just answer that. It's going to be somewhat of a long answer, but I think it is crucial that you see the entire picture for how I kind of view this to get the actual answer out of it. All right, so corporations, so starting on the bottom here, let's say you're, I don't know, some small guy or woman or whatever, and you want to create a business. So let's say you want to do something small for like woodworking. You would need equipment, machinery, and a bunch of tools and stuff. You probably need, I don't know, $150,000, $250,000 just to get going as a business. Most people don't know anyone, like friends or family, that could just pitch them like an extra $200,000. It's just not common. When you step back and look at bigger businesses, so yes, if you wanted to do like, I don't know, I wanted to be a oil and gas person and I wanted to drill for oil. These rigs cost millions and millions of dollars. So to even buy a rig, I would need millions of dollars. To make a corporation, to have all the people to do it, the expertise, the petroleum engineers, the chemists, right? You're going to need a lot of stuff. You're going to need a lot more than a few hundred thousand. You're going to be needing, I don't know, 100, 200, 300 million dollars, maybe even like a $500 million to do this. It's super, super capital intensive to run a business like that. So when you start a business, right, you need capital to do it. Most people don't have the capital. So what do? You need to find investment firms. So for example, there's like venture capital. There's different types of investors, hedge funds, whatnot. There's investment banks, for example. All of them do essentially the same thing. They look at your idea, they look at your business, they look at everything you have, they look at how much money you're asking for, and then they figure out if they can find, that much capital, people that are interested in taking that risk and making that investment. So in finance, that's the investment banking side. That's where the value is added. You're helping essentially the small guy. You're helping someone, on the bottom end start a business and get going. Now, yes, big corporations do mergers and acquisitions. For example, a big company likes a product that a small company has. They might buy out that company. There are a whole other slew of services that investment banks provide. But simply, that's how a business gets going. So let's say I put in, I don't know, $10,000 in a business and it's a $250,000 investment. I only own a small portion. I hold it for, say, 5 years. The company's doing really well. But let's say I have kids that are going to college and I need that money back so I can invest essentially in my kids. What am I going to do? I need to sell that investment somehow, right? So I need to go out and find someone else who's willing to take that position. Now that the business is doing well, maybe my $10,000 is worth, I don't know, $12,000. And so I need to go find someone to buy that. So this is where trading comes in, right? People buy things, they invest, the original investors, they need to get out of the position because they need that capital to do something else. So I would go and I'd essentially, if it was an IPO, initial public offering, so a company that is traded on a stock exchange, you could easily go on there and say, okay, Fidelity, Charles Schwab, Vanguard, something like that. I have this many shares. I'm going to sell them, and then somebody else in the market would buy them. There's market makers who would match these orders, execute the orders, and then somebody else would hold the shares. I would get rid of my shares. I would have cash now, and I could send my kids to school. So that's kind of how the trading works. Now, where it gets more complicated and where people get, I guess, twisted a little bit is that there are trading firms that literally just buy and sell assets to make money. So the sole purpose, people would view this as greed. You would buy and sell assets for the purpose of making money. But you have to see the value that's added in these positions. So for someone like me, for example, say I'm trying to get out of this position, I need the money to send my kid to school. Right? I don't really care who buys it. I just want to sell it, and this is the price I want to sell it at. And if you'll buy it, great. Like, right? We're win-win. Everybody wins. But then what happens is those companies take those shares and they resell them to somebody else who needs them. So yes, there are companies, so capitalism as a whole is built off this concept, which people like to label it as greed, but essentially it's self-interest, and you should not be acting or being forced to do things in life that you don't want to do. And essentially these companies take opportunities like this. They look at people that are willing to trade that are wanting to do business, and they're interacting between them. They make profit doing it. And we'll talk about that in a little bit. But a lot of times these companies too that are investing aren't just investing for themselves. Proprietary trading is a very small fraction of the market. Most of these companies doing these massive trades are like 401ks, so investments for all these employees, pension funds, for example, insurance companies. They're doing investments because there are people that need that money at a different point in time. So you have capital today. I need to put it somewhere in the long run. I would like to get it back at the end. So the same example with the school, right? I buy the shares and then I hold them for so many years. I need to get out and sell them so I can pay for my kids. Investments the same way. You have a bunch of extra money today. You give it to corporations and people that could use the money more than you at the current time with the expectation you should get something back, though bankruptcies occur and you're not guaranteed money back. But what ends up happening is then later down the road, if it does well, you can sell it, get money back, and then use that for like retirement. So vacations and living costs and everything else when you're old. So that's kind of how the investment side of it works. Now, looking at the banking side real quick, and then we'll talk about the two halves, job-wise and value and all that. Banking works a little differently. So banking is essentially like a corporation. So a bunch of people pool money together, just like in the first example, and you say, I'm going to start a bank. A bank's job is to create essentially financial products for individuals who need money. So banks take money from people as deposits, so it's somewhere to store your money safely so you don't get robbed, for example, which is the entire point of having a checking account. Nowadays, you have credit cards and debit cards, right? You can quickly swipe and get access to capital without carrying around like actual physical cash, or in the olden days, carrying around massive bags of gold that weigh too much. But banks just provide a lot of services that are beneficial in the sense that they store capital for you. They make you easy to access your capital. But also banks have products. So let's say I'm an individual, I need to buy a house, right? I don't have $300,000 to buy my house and I need capital to do it, but I don't have it, right? What am I going to do? I don't know enough friends and family that would pitch in and give me $300,000. The builder's not just going to give me money for free. I need someone that's going to loan me the money, and then I will pay them interest back to actually finance that purchase, right? And then over time, I'll pay you back, and then you'll make some money. Again, the whole concept here is that you have extra capital. So somebody has extra capital. They need to do something with it. So put it to work somewhere, which is why you loan it to someone else. And then it makes money. And then at the end of the day, they give you more money back. It's the whole concept, okay? And then we should touch on quickly risk and return here. If you give money to say you have a sibling who's extremely responsible, 4.0 student, always follows the rules, giving them a loan, like I wouldn't really mind giving them a loan because they're going to pay it back. So in a banking situation, right, interest would be really small. I'd charge them like 1%, 2% maybe. But let's say my cousin who, some massive screw up, can never pay their bills on time. They want a loan, right? My first inclination is I'm not going to make you a loan because you're not going to pay it back. You're not responsible. You can't hold a job. So what are we going to do, right? They really need the money. I feel bad, but I don't want to give them the money. The chance that they're not going to pay you back is extremely high, especially when you compare them to your sibling who is extremely responsible. So to compensate for that, you should charge them more interest, okay? The way this works in banking, though, is you can't think about this on an individual level. It's a one or done kind of deal. In banking, you have thousands of customers, right? If you make enough loans at the correct pricing, so, right, the person that's super, super safe that you charge a low interest rate to, and the person that's super, super risky, your net profit should be almost the same in both scenarios. This is how banking works. I know it's shocking because people don't believe me. But when you make loans to really, really risky people, let's say half of everybody you make a loan to defaults, okay? You have to charge a higher interest rate to be able to recoup all the losses from the half that you're not going to get. So you're going to go bankrupt if you charge everybody the same rate. So a lot of people say, Dimitri, it's not fair. We should charge everybody the same rate. And then therefore, banks would be wonderful and like the world would be great and everyone have access to capital. This is not a good idea. So an example of why this doesn't work is if you have those two groups, right? So the super, super safe and the super, super risky. If you had a bunch of people like my sibling, for example, and they're super safe and I make them loans all day, they're always going to pay me back. Maybe say 1 out of 100 people don't pay me back. I'm making really good money and it's super safe. I'm happy. If you had the exact same interest rate on the other hand, let's say it's a bunch of cousins or something, so the risky department here, and they don't have the capital and they just don't pay you back, or they filed bankruptcy, right, and they're not obligated to pay you back, then they just walk from the table free. So now what ends up happening is, say I invested like, I don't know, $100 on this side and $100 on this side. On this side, I'm getting $99 back. On this side, I'm getting $50 back. So as you keep issuing more and more money on this side, you keep getting less and less. You paid $100, you got $50, right? The more you keep making on these loans, the less you're getting back. So the way to compensate for that, to make it enticing for banks and even individuals, right, even as yourself as a human is right making an investment here, if you want to invest on this, riskier side, you need to be able to do enough risky loans that as a population you're getting a return back so that you would at least break even, but more likely you want to make a little bit of a profit. So in that case, if you're making $100, you're hoping to get back $100. You can't afford to take that loss. So that's kind of how loans work. Loans work the same for almost everything, cars, houses, personal loans, student debt loans, all that type of stuff. In general, right, you have to compensate for the risk so that whoever's making the loans can continue to make loans in the future. If they misprice these loans and make a payment or an interest rate that's too small, that company will lose all of its capital that it borrowed from all these investors and go bankrupt. And then literally all the people that we talked about at the beginning as an investment lost all their money. Okay, so this is more or less how investing and banking work and how it kind of ties together. So answering the question about seeing your value in the job. Okay, so this is going to be more of my opinion. This is not like a fact or anything. It's just my opinion. I've always wanted to do trading when I was younger. Okay, that was my goal. I wanted to be a trader. But always in the back of my mind, I had that inkling, that thought of, am I adding value to society and do I actually care? Okay, and I do care. There is this piece of me in the back of my mind. It's still there to this day, right? It always thinks like if I went into trading, I went into investing, I would have to somehow mentally tie to myself that picture, that business model that we talked about, looking at the investors that are putting the money in, looking at people that it's actually benefiting, so those with 401ks, retirements, and pensions and all that, justifying how it adds value as a whole. And even proprietary funds that are buying and selling, they create liquidity in the market so that someone, for example, such as me, who's trying to sell it to pay for school for a kid, at that time, right, you need to think about like, that's what those proprietary traders are doing. They're just charging you a fee to do it. I do not believe that markets are a zero-sum gaming. You have a winner and a loser. Yes, somebody might put money in and might not make as much as the market. Somebody might put money in and lose money. But sometimes getting that money out at that time is more valuable to them than the minor loss that they're going to be taking. So in the investing side, it's very hard, I think, to continually remember that you're adding value and that you're tying investments and adding value to these customers, right? There's customers behind all these investments, and trying to keep that in the back of your mind and how you're actually helping people out. So for example, student loans is a good example, paying for school. Those that are retiring, the elderly, they need the money, right? You're just providing ways to move the money around and make it more accessible and liquid for everyone involved. So investing, it adds value. I think it's kind of hard to see sometimes though. So now from my side in banking, working in banking, again, is the same concept. You have to try to remember what you're doing because I do math and stats all day. I'm just building models, validating models, writing reports, documentation. And then on top of that, I feel like, to be honest with you, the business half of banks don't have a clue what we do 90% of the time. We're undervalued, we're underappreciated, and nobody really cares that you're essentially driving all the decision-making behind the bank. We're not the pretty face with the suit on that's, come into our bank and come make a loan with us, and we're great and wonderful. We're just like the nerd in the back office that's like coding out code that prices all of these loans together. So billions and trillions of dollars worth of loans, mortgages, autos, student loans, personal loans, all that stuff. They're all priced by a model. Okay, so big banks price with models because think about mortgages. You can't price thousands of mortgages every day with one person or a team of people. It's not efficient. You have to create actual models that price these consistently. And again, it makes it fair so that everybody's getting the same prices based on your characteristics. So the risky person, right, the cousins versus like your siblings who might be really safe, trying to price that. Working in the industry, though, as a whole, one thing I enjoy seeing, which I don't get a lot of kind of access to, is there are customer calls that some departments can listen into for quality assurance and all that. It's really interesting seeing, for example, so I've worked in industry for a while. I work in the subprime space right now, but you see people that really need something. Like they need a car to get to work because they have to get to work to make money to pay their bills to feed their kids. Okay. To be able to do this, they need a loan. They don't have the cash to buy the car. So I work in auto too. But they need the money to do this, and being able to actually see the value added, to see that we're helping them out, we're allowing them the loan is super beneficial. Stepping back from a regulatory standpoint here, so a lot of people don't know this, banks that make loans have two halves they're trying to balance at all times. One half is the profitability side. We want to maximize profits because all those individuals and all those people that invested money into this bank that are providing the capital for the bank to function want profits back. So we have to provide them profits, and we're trying to maximize profits. We have the Consumer Protection Bureau on the other side who's worried about the individual. As a bank, though, as well, we are also worried about the individual. If we screw you over, you're not going to come back for a loan with us. Okay? So we have incentives to both make profit and to help our customers and provide the best services as possible, even without regulation. And then on top of that, you layer regulation on top, which makes just a more steady playing field from bank to bank to bank. So everybody's offering the same services at the same fairness, and it provides kind of a equal playing field for everybody. So it's really important to look at other aspects of this too. So things you don't think about. Let's say you have some customer, they've taken a loan, and let's say they have, let's say they have a house. They have a mortgage through you, and they have this house, and the house is just too big for the customer. They can't make the payments. They're consistently behind. And you end up in a situation where essentially if I keep the mortgage on the books, I keep charging them, they're only paying me interest, but they're never paying me principal. Okay? I'm essentially enslaving you into this product. So you're never going to pay it back, and as a bank, we would know that. Banks are required to essentially foreclose on you. This is why banks do foreclosures. People think it's really mean and nasty, but it actually helps the customer in many ways. So you foreclose on the product. So on a mortgage here, I would say, we're not going to finance you anymore. We're going to put you into bankruptcy, into collections. You need to sell the house. The best thing the consumer can do is get rid of the house, sell the house, return the money back to the bank that they can, right? Continue making all your other payments, and then find another option. So downsize to a smaller house. So if you have a house that say worth $300,000 and you can't make the payments, maybe you could refinance that, sell that house, and then buy a house that's $200,000 that would still meet your needs, right? That's an option. Another option would be maybe renting an apartment, renting a house, moving into like a duplex. There are other options out there, and I think this is where the value, and it's hard for me to remember this right because every day I'm thinking, I'm building more models. Am I really adding value? A lot of times, other people in the bank don't seem to appreciate you. Am I in the right industry? Should I move to technology? Exciting, fun. Or should I stay in banking? It's really hard to see that value sometimes. But when you see customer stories and you hear customer stories and you can link what you're doing. So my job's back here in models and validation, and there's all these different layers of, making the models, validating the models, implementing the models, the strategy, IT's implementing these again in real practice, and then finally it gets the customer right. We don't see those, but when you hear those stories a lot of times and you see how we are helping customers, even when customers are upset, I think that's what keeps me in banking, right? I can see from my perspective the people we're helping. I look around like my neighborhood, for example, and realize almost everyone has a mortgage. A lot of people have auto loans, for example. These wouldn't be possible without banks. And just to kind of wrap up the video here, yes, it is very, very challenging, I think, to link your value that you're adding in finance to customers because there are so many layers and you're not going to be able to see it as easily. I'm satisfied in my career. I really enjoy it. But yes, there are days when I'm just like, head in my hand, like frustrated with the job, frustrated with the industry, and not being able to see as clearly at times the value you're adding and the people you're helping. And I think that makes it more challenging. I think if you could see every day the people you're helping, so there's thousands of people that are using these models, and the benefit that it's adding to society in general, I think it's much easier to be excited and motivated and go with it. But In general, just to answer your question, yes, I see a lot of value added on the investing side. So those are traders, though it's a little murky sometimes, but they are adding value in different ways. And then on the banking side, providing products, loans, helping customers out, making tough decisions. So like repossessing cars and houses and foreclosing on things because it's actually in the best interest of the consumer in many ways. It's hard, it's challenging. I think that's what makes banking an interesting field to work in, though. So, anyways, thanks for watching. Don't forget to share, like, and subscribe. And as always, until next time.